my conversation last week with special guests that we have again in our main section this week, Tommi Johnsen and Elisabetta Basilico, told the story of my aborted attempt to take the CFA courses. I ordered the books. For those of you that didn't hear that episode, I ordered the books and was super excited to get into studying for my new designation, and I got through about the first half of the first chapter of the first book and realized I just learned 15 ways to calculate basic returns. Like, there's no way that I'm going to remember all this stuff. And so I closed them up and hoped that nobody at the company who had sponsored me for it asked about how my progress was going, which it in fact happened. Nobody ever mentioned it to me again. I mention that because we have a number of listeners and followers on Twitter who are CFAs, and as I mentioned last week as well, for those of you who are just, running your own practices, CFPs, dedicated professionals, the book that Tommi and Elisabetta wrote is really a great resource for understanding investment management research and getting a better idea of how to interact with that more quantitative and research-driven side of the business, which continues to grow in our industry. So I recommend going out, taking a look at the book, and getting a copy of it. You can access that through their blog, Academic Insights on investing.com. Again, that's Academic Insights on investing.com. And we will also put a link to both their blog and where you can buy their book on our website, value-ability.com. Click on the content tab and then scroll down. We'll have it under both episode 24 and episode 25, because this week, of course, is episode 25, Investment Research Made Easy Part 2, the continuation of our conversation. The Valuability Podcast is for financial advisors, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek. I was a financial advisor and product wholesaler and failed CFA candidate for over 20 years. I am joined each week by my co-host, friend, and mentor, Philip Simonson. Philip has been in financial services for over 40 years, also as a financial advisor, a field leader, sales trainer, and senior manager, covering areas such as advisor development and field operations. But in fact, Philip, actually last week was the first week that one of us was not available, and I flew solo on talking to Tommi and Elisabetta. And the roof, how is the roof, first of all?
Oh, well, thought we had it fixed till we got 2 inches of rain, which was the acid test this last Sunday, and we've got more leaks than we had before we tried fixing it. So obviously we did not get to the source, and hence we begin again. I know the roofers did a great job. It's just the leak is coming from, I think, the chimney chase. So it's a process of elimination.
Roof leaks are like back pain.
Oh.
Once you start tinkering with them, it can get even worse. So, well, and on that note, also, one of the things that kept you occupied last week was your partner fell and injured herself, and I want to send out my hopes for a speedy recovery.
Thank you.
And ask how she's doing.
She's doing, she's turned the corner. That back pain was a great analogy. Compressed fracture of the T11. But she is sleeping better, and recovery has begun.
Very good, very good. Well, you can find the Valuability Podcast on Apple Podcasts, Spotify, Stitcher, and TuneIn. Wherever you find your podcasts, we should be there. We also have a YouTube channel. Search Value-Ability on YouTube to find us there. We also have our own website, value-ability.com. Click on the episodes tab, and you can listen to all of our episodes right there in our episode player. Wherever you find us, please like, review, subscribe, and share. And on that note, I haven't really looked at our likes and those kind of things. I sent that to you in a text the other day. We have 5 reviews, 4 5-star reviews, and 1 1-star review. So I just want to thank the person out there that gave us a 1-star review for wrecking our chances at having a 5 stars very early on in our podcasting career. We're not for everybody. We know that. That's just fine. Thank you for the feedback out there, and as I've mentioned in previous episodes, best thing at this point you can do is share with like-minded folks. If you're listening to us on a regular basis, share the podcast with people that you think would like our content. If you need to get in touch with us, you can reach us via email, info@value-ability.com. Again, that's info@value-ability.com. And then lastly, if you'd like to follow us on social media, Twitter, Instagram, Facebook, we've got it all. Go to value-ability.com and click on the Contact Us tab, and all of our social media links are there. So we will transition into the final third of the conversation that I had with Elisabetta Basilico and Tommi Johnsen, authors of Smarter Investing: How Academic Insights Propel the Savvy Investor. Let's move on then to Chapter 5, the multi-asset investing, and the subtitle of that is Challenging the Industry Obsession with Alpha. And I thought it was funny. This morning I woke up and I opened my slew of automatic emails that I get from all the financial media that I've subscribed to over the years. And the very first article in the very first email was Top 20 Funds ETFs of 2020. And it was gold, precious metals, solar, silver. I was like, well, there we go. The obsession is over. So we'll, that introduction, the thing that leapt out at me at first was the going back, the fact that you cited the first example of allocation where somebody talks about allocation was actually back in the 4th century, where they were talking about allocating your assets, a third to land, a third to merchandise, and then a third, I think the phrase was ready to use, so I would guess essentially cash, right? But again, looking at my own lens, I'm like, oh, asset allocation popped up in the 50s and 60s, but obviously that has gone back further in time than that. And so, the story that we all get, I got in the retail side, was kind of the development of that modern portfolio theory in the 40s and 50s. But are there other examples between the 4th century and 1950? There have to have been other examples of allocation.
Well, I think, the one that this old one that we found, it was pretty common up until risk came into the equation for asset allocation, because before, it was actually in the late 1700s that a mathematician named Bernoulli introduced the concept of importance of risk, and then it was later studied by others up until birth of modern portfolio theory with Markowitz, where you have to take into account also risk when you build a portfolio. But before that, I think that there were other examples, other combination of assets, but it was I think, pretty popular tool. This is an example of almost like equal weighting. So depending on the universe that you were considering in terms of what you thought was a good investment, that you would just, naturally allocate to that universe equally. So
Sure.
I think that is, and then, with modern portfolio theory, the revolution was you need to consider how the assets move against each other, because you can reduce risk by by optimizing a portfolio of assets that are not perfectly correlated, basically.
So interesting. So the big transition then in the last century was going away from kind of just thinking of it as the maxim, don't put all your eggs in one basket. And if you go back to those
Right.
earlier allocations, it's just a third. And while my beginning of my career, I was in compliance, and I have to say that the number of quote unquote portfolios I saw that were a third. there, in fact, there are a couple of big asset managers that still run with those investment stories of a third, right? So
Exactly.
interesting that it comes in. Now, the other thing that leapt out to me in this chapter, of course, was along with the development of the asset allocation process, was this belief, and it's true, but the way that it's framed in the chapter was very enlightening to me, is that 94% of return is due to asset allocation, 6% to security allocation or security selection. And that, again, I'd learned that within a week of being in the industry. But you make a very important distinction, that's variation versus level of return, and that has
Exactly.
never been explained to me and is a huge deal. So why don't you explain a little bit about that?
Yeah. So, in general, one thing that we wanted to bring to the attention with this book is and it's linked to the title about the obsession of alpha of the industry, is to say asset allocation is important in one's wealth management planning. But but how important this study attempted to answer the question, you know, how much of the return variability does asset allocation explain? So how much of the return volatility, that is, how much of the ups and downs in the market, is explained by asset allocation? And the answer to that question is 90+%, which was also studied again later on a different sample by other researcher, which confirmed this result, because this study was then criticized. But the main criticism really is related to the misinterpretation. So, it's not that it's a wrong study, that's the exact answer, but it relates to the ups and downs. Then other study came along that try to better answer the question that everybody is interested in, is how much is explained of the level of returns by asset allocation, security selection, etc. There is one study that we mentioned in the book, and it's from Ibbotson, and it was written in 2010, so more recently. So what that study concluded is that the majority of the level of the return comes really from being in the market. So, if you are invested in the market, you get 75% explained. And then the remaining part is basically equally explained by asset allocation and security selection. So, in my opinion, no matter how you look at it, asset allocation is a little bit of an underrated process in our industry, because if you, in my experience at least, I've seen that the big focus is on alpha, in the sense that market research is focusing on the individual security. Then you have active manager that claim that they can pick the perfect stock or the perfect basket of stock that will beat the market. But then we have evidence that it's not that easy to beat the market. And then you have asset owners that spend the majority of their time and effort in picking the right fund. And so, but I think that, investors need to pay attention to the whole process of asset allocation, which is not just one answer, because asset allocation has a number of steps that are involved, and it's about picking the right investment policy for your risk preferences, looking at the right way, we think, in terms of, how you measure risk. And so the book, in fact, in all of the other chapters, we pick one article that we thought was most representative, quality research, and focus on that. But in this case, we could not, it's impossible to find one article that covers all the aspects that are involved in asset allocation. So we picked a book, which in turn is really a compilation of different articles. So we like that approach too, because it's based on, on the research behind asset allocation. And so when we go through a number of topics.
Kind of the way that it processed in my mind was that obviously if you pick a terrible fund, that's going to have an impact on the level of your return, but the amount of impact that you can have in terms of keeping your return from varying is more affected by spending time on the asset allocation. So that was kind of the way that it processed in my mind, was like you said, like all of this energy is spent on, go to the Morningstar report and, blast through and pick out, oh, this is the best mid-cap fund in the world. And then you spend, 8 seconds on how much to actually allocate
Exactly.
to that, right?
Exactly.
Well, and that leads as well to kind of the thing that always, I don't say it frustrates me, but it's my area of interest, which is you mentioned later on in the chapter the concept of asymmetric risk preferences and how that impacts asset allocation, and that to me is fascinating because I see the fact that many times we look at asset allocation and investment management in general kind of in a vacuum as this is the balance that we're going to use, and even if they are doing a larger financial plan, there's almost no discussion of is there any connection between those two things. They're almost siloed within the process. And I thought that could you explain a little bit about asymmetric risk preference, what it is and how it impacts things? Because I think that was fascinating to me, the idea of having the portfolio altered based on the end use.
Yeah. So first of all, I mentioned that, for instance, modern portfolio theory is based on symmetric risk preferences. So the algorithm, the function that, mathematically speaking, theory is based on is symmetric. Symmetric is when you have an investor that is equally risk averse above or below a specific target. But the reality, at least in my experience, is not such, because if you ask, so in terms of explaining what asymmetric risk preference is, so imagine if you have a client that has, for whatever reason, you ask your client, what's your return target, and he says 4%. Now you have to ask the client whether he's indifferent in receiving a return that is less than 4, equal to 4, or more than 4. Obviously we would like all to have more than 4, but when you dig deeper, you realize that the first priority is to get to the 4, and that he's not He's not happy at all if he does, if he gets less than 4%. He's happy if he gets more, but he's more unhappy if he gets less than 4%. So that's
Right.
asymmetric risk preferences.
Right.
When you have emotion, either emotionally or in practice, a different risk aversion, whether you're below or above a return target.
Right. And that also plays into very, very utility based parts of a financial plan in terms of, most of my career has been spent in specifically 65 plus income distribution planning, and in those simulations negative returns early on have devastating effects and are the number one cause of the failure of the plan. And so not even just emotionally, but in terms of your actual quantitative goal of the overall financial plan, there is can be some aversion to certain risk areas.
Exactly. So you could be, and there are practical example, real life example where you are a pension plan and you run into trouble if your funded ratio is below a certain number. And so you need to get to a return as the priority to keep the funded ratio above a certain level. Or you may be a foundation who needs to give away a certain amount of money by law every year. And so again, that's another example where reaching the return target is number one priority instead of returning above. Or even in an individual investor who lives off his financial wealth and
Right.
his standard of living is based on that. So, there are real life examples. I think the majority is asymmetric risk preferences, which can be a problem if you use the wrong algorithm, because you end up building a portfolio that's not optimized to your preferences.
Right. Now, I also mentioned in the chapter is and this is something I had not heard of before that was very interesting to me, and more than just a kind of interview question. Could you explain full scale optimization and how that's applied for investors? And then secondly, do you foresee that becoming more common at the individual retail level?
Sure. Yes, that's a great question. So, full-scale optimization comes out of the book that we review, and it's research that is done by Mark Kritzman, which is the author of the book and the author of many papers behind this book that we mention in the chapter. And so it's a technique that it's better suited when two hypotheses that are at the base of a modern portfolio theory with mean variance optimization, which is the most popular technique that the industry uses. It's when returns are not well represented by a normal distribution, and when the investor utility function is not quadratic, i.e., when an investor does not have symmetric risk preference. So when these two conditions, either or, are not met, then the standard procedure can be a problem because they understate risk. And so full-scale optimization is a more flexible type of optimization that allows you to change the utility function, for instance. Now, we know that returns in many asset classes are not normally distributed. There's a number of papers that demonstrate that even like treasuries or corporate bonds or international equities are not normal. You have returns that are extreme more often than what a bell curve tells you. And then again, like we were mentioning before, oftentimes an investor has asymmetric risk preferences. This is an optimization technique that is better suited when these two conditions are in place. Now, obviously, the industry uses mean variance. I don't know whether it's laziness or other reason. Full scale optimization is not, as popular as mean variance. My guess is that it may become more popular, but I'm not sure. Now, mean variance, you can solve mean variance with Excel, basically.
Right.
To solve full scale optimization, you need a little more computational power, but it's not, impossible with the computers that we have nowadays. So,
Yeah, I think it leads to kind of my, like I mentioned before, and it later on in the chapter, it's what popped into my mind when I was reading it. Was, and this is exactly what robo advisors struggle with. And then later on in the chapter, you start talking about that part of the industry and the fact that they have not kind of, even though they are technologically leading on that front, they're not really leading on the nuts and bolts. So I mean, the analogy is they may be giving it a high tech right now shine on the outside, but the
yeah.
engine is staying the same.
Yeah.
And I thought that was very, very interesting as well, because it speaks to this, the way that we manage that risk at the retail level is essentially a hack, right? It's keep a year in cash or keep 6 months of income in cash, the emergency fund concept, which from a financial planning standpoint, obviously you need to have, but from any financial advisor knows that the hey, just hang in there conversation isn't fun with that small minority of people that end up, and I just went through it earlier this year in March with one of my consulting clients. Came in and he said, yep, sold out right at the bottom of the market. One of his clients just couldn't take the fluctuation of the portfolio, and they sold out, when the market was down, double digits. And so kind of the way that we manage that isn't actually integrated with the investment management process at this point for the most part. And that's why I found it kind of leapt out at me as like, that's why I struggle with the robo advice side of things, is that it doesn't integrate with the concept of real world risk. I mean, and essentially those two things you mentioned, non-normal distributions and asymmetric risk, I mean, those are pretty much every individual investor lives in that world, right? There's a very few individual investors that have truly symmetric risk.
It's better when, as Elisabetta said, returns are not normally distributed, the utility function's not quadratic, and you have the asymmetric risk preference. And mean variance optimization, when that optimization happens, there is an algorithm that drives for computer efficiency. It takes less time, it takes less computing power. It will drive right to the solution once you've set up the parameters for risk and return, expected return and risk. In full-scale optimization, you're not bound by that algorithm. It's called the method of least, I've forgotten the exact term, but so timing is of the utmost importance. In mean variance optimization, it's very efficient in getting an answer. So you can do it in Excel.
Sure.
Scale optimization, you're looking at all possibilities, and so it can handle some of these other problems that mean variance optimization is really unable to do. So again, due diligence, figure out what kind of optimizer are you getting, from the robo advisors.
So let's jump to chapter 11, which is women in the investment management realm. Now, obviously, this, I think you mentioned, and it was either in an email or in the book, that this just kind of popped up as you were doing that, when you realized that, hey, we're two women writing this book about investment research. Let's have a chapter about women in investment management. My personal experience has been that there's been a generational shift in clients, at least, that in previous generations, almost always male dominated. The male in the couple was doing the finances and dealing with the investing. But in my generation and in younger generations, I've seen a noticeable shift to even be actually more dominant, that the females in couples are more often running the personal financial side, as well as being, if not primarily involved in the investing side, certainly way more involved than previously. Why do you think there has not been a similar shift in the investment management or financial services world from the professional side?
Well, I think that one of the big reason is that the finance industry, the investment management industry in particular, comes out as, and it is pretty unfriendly to women. And so this is definitely one cause. So women are, afraid of joining because it's a tough environment. And then the number two reason, which is also back, the first one is more back from experience, but the second reason is back from research, and it's almost like it's a vicious cycle where there is an investor bias against female managers and advisors, because the investor prefer our male colleagues. And so then fund families are afraid to hire women because they don't raise as much assets as our male colleagues. So I think those are at least two reasons why.
Yeah, I think that, the research is pretty interesting and illustrative of the fact that women do as well as, if not better than men. They tend not to trade as much. They're a little more conservative in their opinions. But they suffer from the social aspects around it, that people who are buying mutual funds, investors, are not that comfortable. Portfolio manager. The other social aspect of that is that they're not really stated mentoring, sponsoring types of programs that within companies that are stated, having a stated diversity goal that actually you have a fundamental process of implementing. So I don't think that, we talk about the math gap, between men and women. And I think that that's not nearly the issue when you compare it to the social hurdles that are really out there.
Just from my own experience, and at the retail level, it is also heavily male dominated, and honestly, that I'm not always comfortable with that atmosphere. I mean, it's, I refer to the wholesale side of our business as kind of the last bastion of the kind of frat boy approach to business. And there are times where I'm like, this just like, it's not guys being guys. This is not fun, and it's not. I wouldn't want to be a female in this environment with the way things go sometimes. And so I think certainly there's that side. But the thing that leapt out at me the most in this was that there are quantitative, if not proof, but certainly suggestions that female investment managers and female analysts outperform their male counterparts, correct?
Correct.
Yes.
Right. And if you take that off and just put a black box around it and say, here's some outperforming. We were just talking about the fascination, the focus on outperformance. You put a black box around that and say, here's some potential outperformance.
Mm-hmm.
like I mentioned when I was writing these downs, I said this is really more of an incredulous statement than a question. Like, so hyper focused on outperformance, and they're not just wholesale trying to take advantage of this. How, like, it kind of does boggle the mind.
Yeah, I think Elisabetta makes this point. I'll let her go on, but we were talking about this the other day, and the idea that you have that outperformance. There is the male dominance. It's really a social issue, but it also means that we need help from women and support from the male segment of that. Elisabetta says this a lot better than I do, but we need to have people maybe like you who are willing to say, we're not really looking at the right indicators here, and giving women opportunities, looking at diversity, in that sense, is there benefits. In the book, I think we put it as, it's to answer your question about being incredulous, it's a self-inflicted wound.
Yeah, no, I mean, to go back to your comment, in terms of like solution to start to reduce, to accelerate the reduction in this underrepresentation of the women in finance, of all the solution, I think that we need to make sure that we say that we do need the support from our male colleagues, the male colleagues that believe that having diversity in their firms, at conferences or other events, they need to help us. So I give the example, for instance, of when a male colleague is asked to join a panel at a conference, I think it'd be nice if he said something like, hey, is there at least one woman in the panel? If not, I will not participate. Be nice if we're half and half, but even just one would be great. But until there's not that action, I think it will be hard to reduce the gap. And this could be applied to other situations as well.
So we really appreciate your inviting us on.
Yeah.
Yeah, no, absolutely. No, it's something that I was raised by a single mom, or she had three sisters, and they all lived with us over the time of my childhood. So I almost always had what I called, quote unquote, my upstairs mom, and always made me aware of my own kind of blind spots, as it were, as how men interact with the world and don't see the things that are challenging to women. And so even when I was wholesaling, like, as an example, golfing is a huge part of the retail financial services world, and I started to notice that I would invite women golfing. Many of them weren't comfortable golfing when it was me and two other guys and then them, and so I actually started doing just groups of female advisors, and they all had a great time doing that. And so it's just little things of just asking the question, right? Like I just ended up asking, and the one was like, well, I'm not very good, and whenever I golf with men, they get frustrated, and it's not enjoyable for me. And I was like, all right, well, you pick who you go with. So she picked a couple of other female financial advisors. So yeah, like the making societal changes is always challenging, but the first step is naming them, realizing that they're there, and then taking steps forward. Like, yeah, that was the one that just jumped out at me. I'm like, I can't imagine looking at a fund and saying, oh, this is a great performing fund. Oh, but it's run by a woman. I'm not going to put my money into that.
Yeah.
But those things do exist out there. So are there any other differences between men and women in investment management? Are there any others that we missed?
I think the two big ones are the risk preferences, or when managing money, men are more aggressive and then the turnover, which both contribute oftentimes to the fact that performance is better, because the more you turn over the portfolio, the more costs are involved, for instance.
Right.
And then with risk aversion, you control better the drawdowns, which over time with the compound effect can help out a lot. And then the literature actually shows that in terms of other factors like the background, the credentials, studies, very similar. It's not, so again, besides the problem with the discrimination that we have to face in the industry, the industry is missing out by not having more women. I think it'll be a win-win if there was more diversity. So we have to strive for that.
Well, I want to thank you both for joining me today. And just to remind everybody, their blog is academicinsightsoninvesting.com, and there is a link to the book, Smarter Investing, How Academic Insights Propel the Savvy Investor. Again, we will also put links on our website, value-ability.com. Click on the content tab and scroll down to episode 24. I do just quickly want to mention both Elisabetta and Tommi are on Twitter. You can find Elisabetta at @ebasilico, and that's B as in boy, ASILICO, and at Tommi Johnsen, that's TOMMIJOHNSEN. They're both on Twitter, and then they're also both on LinkedIn as well. I will put links to their Twitter pages on our website as well. So if you're driving around and can't jot those down, just go to value-ability.com, click on the content tab, and go down to episode 24, and we will have all of those links there for you. I want to thank you both for spending time with me today. It was super interesting, and I just want to mention to people as well, one of the great things about this book is that the chapters are episodic. And so, I was a big reader when I was young, but these days I'm busy, I'm always doing something, and the times that I have to read are usually limited. And so this was awesome to be able to, grab it, 15, 20 minutes, read a chapter, and each chapter is really self-contained. So, and I'm excited also to learn. I didn't gather from the book that you're doing this on the website as well. So I will definitely stay tuned and remain a fan. So thank you both for spending time with me today.
Thank you for having me.
Yeah, thank you, Dan. It was a pleasure.
So, Philip, what questions do you have for me about the conversation and the book?
First, Dan, thank you for running this solo. Appreciate you stepping to the plate.
Of course.
First question I have for you, as you think about our listeners, what's the one or two things you have taken away that could benefit our listeners in running their practices more efficiently and effectively with this quantitative research?
So the first one that really jumps up is, of course, the 94% of investment returns being attributed to asset allocation and 6% to security selection. The fine point there that I don't know if I'm the only one that missed it or if everyone else feels this way, but I was always under the assumption that that was related to the level of return, not
right.
the variance
of
the return. Too. Yeah. And honestly, I think it's one of those things that even if it is in texts and literature, not enough is made of that. And yes, that goes to immediately to the conversation of active versus passive and, what your thoughts are on that. But if, like many of us, you have come to the decision that spending time on chasing, excess alpha is not the best use of your energy, I think it makes the asset allocation portion even more important, because if you have made that choice, you're not going to affect that side, right?
Mhm.
You're not going to pick an index fund that outperforms other index funds. Yes, there are ones that have better expense ratios and whatnot. And yes, you need to do your due diligence, but you're making that choice from a utility standpoint that you don't believe that's an effective use of your time. And so the place where it is then an effective use of your time is in the asset allocation front. And then also kind of hinging off of that is this, I mentioned it in the conversation that we really deal with the relationship between allocation and the end financial goals with essentially a hack, right? The emergency fund. We're not tying, as a general rule in the industry, the way the allocation is built to the end goals. And honestly, I didn't even know that kind of algorithm existed. So, learning about that full-scale optimization, that would be something that I would certainly be taking a look at.
I'd agree. That was very powerful.
Yeah, just one of those things that if you're not involved in the academic side of things, I have not seen any real reference to that concept anywhere in the regular financial press. And so, we've got I've got a meeting scheduled with a company that has a software package that they tout as kind of revolutionary. I'm actually very interested to find that out. Hopefully it will turn into something that we can have on a future episode that hopefully, if it doesn't involve that specific thing, I'd be interested to see where that is getting pushed, because I think that's the next kind of generation of place where the industry goes. Is like asset allocation's been around for a while, and it's been a great thing, and it's done a lot of things for managing risk, but it's not perfect. And so, for the everyday advisor, knowing that stuff is out there and seeing it on the horizon, I think it's really important to keep that in mind and keep your eyes open for new and different ways that you can add value to the client's portfolio. So that would be the first big takeaway. The second one that I say it in the conversation with Tommi and Elisabetta, I find it just dumbfounding that it is statistically provable that female analysts and portfolio managers outperform their male counterparts, yet fund flows to female managed funds are lower than male. Like I use the same analogy. If you put a black box around it and just say, here is something you can do that gives you outperformance, that's everything in our industry. The focus on outperforming your competitors is gigantic. And here is a statistically provable event, and it's being ignored by both investors and the industry in general. And so that, to me, was also incredibly eye-opening. Now, the thing that I've been kind of mulling that over the week since I've had that conversation with them, and one thing I thought would be super interesting to find out, and I'm not sure if it would be possible to do a research study to figure this out, but is it possible that because of the structure of investment research and the academic side of investment management, that only really well qualified and smart women end up making it through. And so that's one of the reasons for the outperformance. I wouldn't think so. I wouldn't think that would necessarily dissuade, but it was just something that occurred to me, and from that standpoint of, there shouldn't be any reason why one gender outperforms the other from just a, one person versus another person, but to see it out there in research and in black and white, and then to know that was also the other thing that was a little bit shocking, but again, probably shouldn't be surprising, was I can't imagine looking at a fund and thinking, oh, a woman runs that, I don't want to put my money into it. Like that. I don't know that I ever actually look at the name of the portfolio manager anyway when I'm looking at funds.
Right.
I don't know that it would ever enter my decision-making process. But those were really the two big things that jumped up at me that I think were very, very interesting from the conversation.
And when I heard that, and I immediately thought back in my almost 40 years in this career, some of the best advisors, some of the best leaders I've worked for, consistently are women.
Yeah.
Marietta was a top financial advisor, top district manager, top divisional manager, top regional vice president. Learned from her many, many wonderful things. I think, when you look back at some of the offices that we've run, Dan, we've had, the women are generally the top performers. I believe, and you look into, going back to the interview we did with David on education and how making decisions, you can take out, a brilliant mathematician, but you can look at everything logically and look at all the facts. However, there's always, because we're humans, there's always that one side of the equation, the emotional side, that comes into play, and it's that EQI. Sure. And I think, the intuition that I think women have, this is not empirical, but I think they're better at using their gut, using their heart, and helping them make better decisions besides just using the quantitative. So I'm not, kudos. That's I just love that one. So that was.
I agree. You and my boss at the second insurance company that I worked for, Steph Kinney, are my two favorite managers of all time, and very similar characteristics. Very focused on wanting the best for their people, very detail oriented, always following up on things. You introduced me to it, and then Steph was the one who really made me enjoy having. When I first got into business, and you'll know this because you were my first manager, I really rebuffed against having a manager that asks me about the tasks that I have due, and kind of, I saw it as micromanagement. Mm-hmm. But later in my career, when I got to that point in my career, and still to this day, I very much enjoy that. I like being held accountable. I figured out that I am better when I have somebody that is paying attention to what I'm doing. And when I was 20 to 25 years old, I would have stomped up and down and told you that I'm better when I'm on my own and just slinging from the hip and I get stuff done, and yeah, it's nonsense. Better when I have somebody that's holding me accountable.
Yes, I think we all are, and that's that old saying that resonates, and it's people do what you inspect, not what you expect. And right. It's how you say what you say when you're doing those reviews. And if you can link them to, helping that individual achieve what it is they want out of their career, and they see that linkage, then it's more palatable to the individual. So, very good summary, Dan. I think excellent insights that you've gained. how would you like to wrap this up? Do you have anything else to add?
No, the one other thing that I just, again, thought was very, very interesting was the amount of bias in academic investment research. I mentioned it during the conversation, but it just never ceases to amaze me at whatever level, no matter, you can't educate bias out of people.
No. That's the human nature, and that's what
right.
That piece of the being a human. We're always going to have it. It's the emotional piece that David was mentioning, and that overconfidence bias is a prime one, and that can get stereotyping, but the male's ego in trouble. Ego. Lisa would always remind me, ego stands for edging God out. You know what? Times I got in trouble or made poor decisions when I was thinking I was God on earth here, or some higher power. No, you're not.
Yeah, and even to the level that the bias is conscious from the standpoint of going into the data and looking for things to generate statistically relevant results. That everybody is susceptible to it, and as I mentioned in the conversation, I just always think of the quantitative, the analysts and the managers as more logical and dispassionate than the everyday person, but it exists at every level. It's just slightly different, and it's applied based on the world in which you're living. Everybody wants recognition. Everybody wants to further their career. And so, just being aware of those things in other areas makes me a little bit more comfortable at saying, okay, I can find these in myself and notice them in myself and not, I don't beat myself up over those biases, but when you find one and you're like, oh, I've been operating under a false impression all this time. You can sometimes think, it happens everything, right? You always think, it's something my mother said to me, you would worry a lot less about what other people think of you if you realized how little they actually do think about you.
Mama was pretty smart. That is so true. There's that self-talk.
And yeah, it's stuck with me that, hey, you're thinking about you all the time, and you're taking your biases and blowing them up. And you know what? Everybody's out there dealing with their own thing, and they're thinking about that most of the time. So yeah, just a reminder that those things exist at every level, and to be aware of them, certainly, but also to know that they're humans. So, well, that wraps up our conversation for this week. I want to thank everybody for joining us as always. If you have topics or questions that you would like us to cover in an upcoming episode, reach out to us via email, info@value-ability.com. Again, that's info@value-ability.com. If you would like to follow us on social media, Twitter, Instagram, Facebook, go to value-ability.com and click on the Contact Us tab, and all of our links are there. Again, if you'd like a copy of the book, Smarter Investing, How Academic Insights Propel the Savvy Investor, go to Elisabetta and Tommi's blog, academicinsightsoninvesting.com. Again, that's academicinsightsoninvesting.com. There is a link to where to buy the book there. We will also put it on our website at value-ability.com/content. Go down to episode 24 and 25. We'll have those links there as well. Next week, episode 26, 3 generations of financial services. I'm very excited for this. We are going to have another guest, a friend we have made via Twitter, Brett Fulmer, otherwise known as Broker Brett, is his persona, a financial services professional in Southern California. He does property and casualty insurance, employee benefits. He is a podcaster extraordinaire. I've seen him on a number of YouTube channels. He is involved with a fintech startup in Canada that is working towards becoming the Amazon of insurance. So involved in lots of different things. And what occurred to me was that Philip is a baby boomer. I'm a Gen Xer. Brett is a millennial, and we have all entered into the financial services business. So we're going to have a little round table where we each share how we got into the business, some of the hurdles that we faced, and then compare and contrast how things were in the past to how they are today, and then how we think things will develop in the future, and some of the things that people face getting into the financial services industry today. As always, thank you for listening. Be sure to join us for that next week. And remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances, and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.